We're here to talk about the Silicon Valley real estate market for the week ending November 28th, presented on Saturday morning, November 29th. These are the key sections that we're going to go over with the corresponding chapters and somewhat descriptive graphic and title. You can jump to the sections that are most interesting to you. The concept is we do a quick summary of Silicon Valley, then we get into the micro market areas, what's happening in each market, distributions, come back and do a little bit more Silicon Valley. Then we jump into covering the greater Bay Area for about the last 7-8 minutes. It's about a 45-minute presentation overall. Let's get into the first data slide. Here what we're looking at is 3 key graphics. The first one is the turnover rate, and that's in this purple-green line combination. Not sure why it changed colors on me, but this is the turnover rate of the marketplace. How long would it take to turn over the existing inventory one time at the existing rate of sales? The higher the number, the slower the market, because as a seller, you want a quick turnover. If the market's fast-paced, it's quick. You can see we're right now about 115% of normal. So a little slower than normal, but keep in mind Silicon Valley is normally a very fast-paced marketplace. So the fact that it's a little slower than normal is probably a good thing overall. Then you move down to the orange line, which is the offers accepted, which is the demand side. And the demand side is more important than the supply side, because the demand side is the side of consumers willing to write the checks, commit themselves to a 30-year mortgage, or have the assets to pay cash for the property or any combination thereof. You can see that we're right now at about 78% of the normal level of transactions for this time of the year. I compare the same 35 days every calendar year. We're looking at the 28 days in November and 7 days in October would be the 35 days to get this current level of sales. And then the third number on here is the active inventory. It's important because it's the other side of supply and demand. It's the supply side, but in my opinion, it's a little less important. You can see right now we actually have a little bit less inventory than we normally do. One of the reasons for that is when you look at a 10-year median, which is how I come up with the typical level, and you have a holiday like Thanksgiving, which is a significant holiday, it moves. It can be as early as, I think, the 22nd and as late as the 27th. This year is the latest it can be. And so when you look at it, we're comparing some days that are past the holiday. The fact that we're less inventory now is not surprising. We'll have a big run-in up of inventory right after the holiday, basically next week. I expect to see an increase in inventory. Here now, as we're looking at the key indicators down the left-hand side, and we're looking at the last quarters of data. We're going back 13 weeks plus the current week, which is the middle line here. And then we're going forward 13 weeks, but only on trend data. We obviously don't have the actual data into the future. And the first one, again, is the turnover time. A quarter ago, we were at 42 days, and now we're at 38 days, call it. So the market has accelerated, but the market normally accelerates. So the 38 days that we're at now is actually 15% slower than normal, where the 42 days, which is actually a slower market, was only 5% slower than it normally is. People don't understand, that we can have a faster paced marketplace going into the holidays, even though there's less volume. And then you have time to sell. And on this metric, instead of looking at the median or the average, which I both think have significant deficits, I'm looking at the median of the 50% of the marketplace that doesn't sell their home basically as soon as the seller is willing to look at the home. So in other words, I'm looking at the third quadrant, the 75th percentile, and that took 33 days, and now it's taking longer at 36, but just the inverse of the turnover rate, the time to sell was 40% longer a quarter ago, and now it's only 7% longer. So on a percentage market, the time to sell is actually improved, even though the time to sell has increased in the number of days that it actually takes. Not intuitive, but there is not only the time to sell, it's how many sellers are successful, because the turnover rate includes those sellers that are never successful. The sellers that come on the market don't sell and go off the marketplace. Where time to sell, I'm only looking at the sellers that actually do accept an offer. Price reductions are the price reductions that the seller initiates before the offers come in to try to get that offer to come in. These numbers are very small because a large percentage of the marketplace, about 85% of the sellers, typically do no price change whatsoever. They price their home, they do their homework before they come on the marketplace. We were taking a 1.6% price reduction quarter ago. We're taking a 1.56 price reduction. So we're basically taking the same amount of price reductions, But a quarter ago, that was 83% more price reductions than normal, and now it's only 40% more price reductions than normal. Normally, you're only taking 1.1% price reduction in the current week. And in a soft marketplace, you're taking 2.4%. So we're not in a slow marketplace, but we're also not in a typical marketplace. We're in between those two. Buyer overbid. This shows a measure of how much competition the buyers are sensing when they're going out there and presenting their offer. A quarter ago, we were overbidding 3.1% when we normally are overbidding by 5.7%. So buyers were overbidding 2.5% less than they normally do a quarter ago. Now they're actually overbidding 0.5% more. They're overbidding 5.2% instead of their typical 4.7%. So the buyers are sensing more competition now than they were a quarter ago. Inventory is a supply, and I only look at those listings that don't have an underlying contract. We were at 96% of normal. We're at 97% of normal. So we're right at the same level of normal. But look at the inventory raw count. We went from 2,500 down to 1,800. You've lost somewhere between a third and a quarter of your marketplace, but that's what normally happens at this time of the year. We're on that steep downward, dive downward as we go into the end of the year. The end of the year is when we have the least inventory typically. Offers accepted, we were at 83% of where you'd expect it to be at almost 2,100 transactions. Now we're only at almost 1,700 transactions, but that's only 78%. So the number of offers coming in the door, offers that are actually accepted, is decreasing a little bit more rapidly than it normally does. Not hugely, but you can see that we're between the gray line, which is the 10-year typical number. That's where you'd expect the market to be. And the blue line, which is the coolest you expect the market to be. You can see that we're coming up to the end of the year right through here. And you can see how tight the market really comes in at that as the end of the year approaches. And the number of closings is on there just because it's what the industry functions on. And it's going to be very similar, but lagging behind the number of offers accepted. You can see that we were at 78%, and now we're at 80%. So we've actually had a slight improvement, slightly less reduction than we normally do, therefore leading into a slight percentage increase. Here now is the first table of micro markets. What you can do on here is on the yellow line, that's just the raw numbers. On the raw numbers, as far as price reductions, that's actually favoring the buyer more than normal. But the turnover rate, which is actually the key indicator, in my opinion, the most important indicator out of all of them, that's starting to go hot. That's starting to favor the seller. So the market, it may be slower or faster than it normally is, but it's fast enough that the market's really favoring the seller more than it is the buyer. Now, obviously, if you're in Pleasanton, Dublin, Castro Valley, or Livermore, it's going to be favoring the buyers. Now you move over and look at the overbidding. That's red hot, except for things like the San Mateo County coast, which is nicely favoring the buyers. Buyers going in and overbidding 4% under the seller's ask price and getting their offer accepted. And that's on average. And yet 13%, which may sound like a lot for people that expect the price to go down, is actually a very small number. Normally, we're quite a bit higher than 13% of the sellers getting more than their asking price. And you can see that up and down. Silicon Valley overall is at 60% of the sellers are getting more than their ask price. And then the green are comparing the data to the past 10 years. These are the absolute numbers over here, what the conditions the buyers are feeling. These are the lagging indicators. And these are whether the market is cooler or hotter than normal. And if you just look across the board here, you can clearly see that we're bluer than normal. We're favoring the buyers more than we normally are. What I'm trying to say is, yes, the market is still fast, as witnessed by the turnover rate over here, but it's favoring the buyers more than it normally does. So we're normally superheated, and now we're just a hot marketplace in Silicon Valley. Then you move over to appreciation, which is on here for a point of interest. Having a little discussion online about the appreciation rate. You can see the appreciation rate for San Mateo County is 67%, but the only one area, and it's a fairly small volume area, the expensive areas is the only area that has a higher area, and at 27%, it would make up for the 70%. So how can you have a 67% appreciation rate when overall these numbers look like it might be closer to 50%? It's as simple as, if the expensive areas, Menlo Park, Atherton, Woodside, Portola Valley, are making up a slightly higher percentage of the marketplace than they normally do, that would raise the median without raising the property values. The micro market numbers are a better indication of what's happening to property values in each given area. Not only are the numbers different, they're more realistic because they eliminate market shift. It's harder to have a market shift within Redwood City than it is among all of San Mateo County. I hope that's a little clear. And then the last one is the sale price. Here, color is just the blue is the affordable areas because that's more favorable to buyers. Red is the expensive areas. And instead of following just the median number in the middle, I follow the lowest 10 percentile on the left and the highest 90 percentile on the right. So you have a price range in which 80% of the homes fall in each one of the micro market areas. Here's some text for those that are following on their own or someone that isn't quite understanding what I'm talking about, and ask questions too. Now here's the first micro map. So this is the turnover rate. This is how quickly is the market turning over. How long does it take to sell the existing inventory one time? You can see the high one right now that I'm picking up is in Castro Valley, Dublin area, where it's taking 125 days to sell their inventory. Alameda County overall is 44 days. San Mateo is 34 and Santa Clara is 33. Overall, Silicon Valley is at 38 days. So in a little over a month, 5 weeks, basically, we would sell out the existing inventory at the existing rate of sales. Now, this is the turnover rate compared to typical. Santa Clara County, you can see the areas that are blue, they're taking longer to turn over than they normally do. And the areas in red are taking less time. So Redwood City is only taking half the time to turn over that it normally does. And you compare that to something like the San Mateo County coast, it's almost taking twice as long. So you almost have a factor of 4 change from half as fast to double the time that it normally takes. Here's the time for the typical seller to sell. This is the 3/4. This is where I'm ignoring the sellers that come on the market and sell right away. And I'm looking at the median of the remaining sellers. So how long is it taking? You can see we're right around 35 days. Alameda County is longer at 39 days. And, you know, it's hard to imagine that your turnover rate was 120 days for Pleasanton, and now the typical time to sell is 42. What that's saying is the sellers that are serious about selling adjust their price to the market conditions and are successful in selling. And those that aren't going to adjust their price stay on the market and never sell, which adds to the turnover time of the marketplace, but doesn't add the time to successfully sell. You can see in Foster City, it's the 12 days. I think that's the lowest on the whole chart. And overall, the highest is 40, 45, 64 days in Saratoga and Los Gatos. And I'll also point out that there are areas like Saratoga, Los Gatos, and South County that in Santa Clara County that have longer marketing times than their compadres. You know, you'll notice that the balance of Santa Clara County is probably around 25 days. And those two areas I said are basically around 60 days. Doubling is a little aggressive, but back when I first started, I used to have a little rule of thumb that Santa Clara County sold in 45 to 90 days was a balanced marketplace, and Saratoga, Los Gatos, and Morgan Hill, Gilroy, South County was 75 days to 150 days. Those have, in my opinion, have accelerated slightly, and I'm now using basically 40, 42 days, depending if I'm talking about weeks or days, to 80 days for Santa Clara, or 6 to 11 weeks. Here's the time compared to normal. So you can see the market's fairly typical. You got Foster City is a little faster than normal. You got the expensive areas that's faster than normal. But the East Bay overall, Alameda County is slower than normal. I'm not seeing in any area in Alameda County that's below 100%, where every other county has numbers above and below. So Alameda County is definitely taking a little bit longer to sell than it typically does based on the previous 10 years. Here's where price reductions are happening the most often. You can see South County and Saratoga, Los Gatos, the coast, you know, the Bay cities, the expensive areas, you know, fairly widespread where they're taking more price reductions than I would typically expect. That's based on round numbers, though. It's based on the raw count. So anywhere from a 0.25% to 1% reduction is normal. If you're increasing your price to a 0.25% reduction, that's a fairly aggressive marketplace. And a 1 to 5% price reduction really favors the buyer. And you can see that you have that 5% price reduction going on in the coast. And these are price reductions that occur to get the offer in the door, not price reductions that occur when the offers come in. Here's the price reduction compared to the 10-year normal. So where you're taking larger price reductions would be blue in color. Where you're taking less price reductions would be red in color. Redwood City, Cupertino, Sunnyvale, Foster City are the three micro market areas where sellers are actually taking less price reductions now than they normally do. The rest of Silicon Valley is either taking more price reductions than they do or the same as they typically do. Here's the frequency of price reduction. So now we can just talk about how common is it. In Foster City, not a single seller is taking a price reduction. And then you go from 0% all the way up to, is 52% the highest I'm seeing? Yeah, 52. So you have the slowest area, or the area that's doing the most frequent price reductions on the San Mateo County coast, where more than half the sellers are doing a price reduction. To go to the Bayside, Foster City, where essentially no sellers are doing a price adjustment. And this is compared to normal. So of course at 0, Foster City is red hot, and San Bruno is slow at 150%. Now it's interesting that the coast was actually doing better compared to the 10-year normal than Daly City Pacifica. It's not doing as well as raw count, but it's doing better compared to normal. And then you go down to Hayward in the Oakland area, and you can see that you're quite a bit bluer than normal. So there you're having a lot more frequent price reductions. In fact, in Berkeley, you're having 2.5 times more sellers reducing their price, which is actually surprising because Berkeley's doing pretty well, but it might be doing well because of all those price reductions. Here's the overbidding. So we're flipping over now and looking at what the buyers are doing. Red is favoring the seller. So clearly there's aggressive overbidding going on. In Silicon Valley overall, 5.2%. Santa Clara County is 3.6%. But look, it goes from -1% in South County, which means buyers are coming in at 99% of the asking price on average, which means there's a fair number of buyers going in at greater price reductions, all the way up to 7.7% above ask price in Cupertino and Sunnyvale. But then if you come down to look at Berkeley, 21% above the seller's ask price. So, I was just talking about it was weird that Berkeley was slow in whatever benchmark I was just talking about. And now the buyers are saying, the prices that they're going in when they bring their offer in is great, and they're going 20% above the seller's ask price. Pleasanton is 2% below. The San Mateo County coast is 4% below. So you have a large range. So if someone's going from the San Mateo County coast, for example, to Berkeley, the two markets are not even related. One, the typical buyer is going to go in 4% below the seller's ask price. The other one, they're going to go in 20% above. And even if you're in a 20% above marketplace, if the sellers price their property aggressively high, you're not going to pay that 20% over. It's almost like list prices are reference points and really not anything more than that. They're really not any indication of the seller's expectations or the market expectations based on my experience. Here's the overbidding compared to normal. So you can see where you're having more overbidding than normal. The coast is clearly less bidding, and Berkeley is more, it's 7% more. So even though it's 20% overbidding, that's only 10% more. So normally that would indicate that Berkeley would be about an 18% overbid based on the last 10 years. That would suggest that there's a high demand and very little supply, which is the overall story of Silicon Valley, which is part of the reason our prices are so high. Here's the frequency of those overbids. So how common are buyers overbidding? Overall, 60% in Silicon Valley, and that number varies from a high of 62% in San Mateo County to a low of 58% in Santa Clara County. So this is a metric where Santa Clara County is doing the least well, but having 58% of your sellers receive a bid that's over the seller's ask price is still a fairly aggressive marketplace, no matter how you look at it. Here's the compared to normal. So in Santa Clara County, you're a little cooler than normal at 96%. Santa Clara County is actually doing slightly better at 101%. San Mateo doing better at 103%, and Pleasanton doing quite a bit worse at 91%. And you can see those areas along the 580 corridor that are doing the least well. They did fairly well early in the pandemic when people were doing remote working. People went out there to get more house for their money. And now I think with people being forced back to work more frequently, that area became less desirable. Here's the long-term appreciation since the 2015, the last 9 months. There was quite a bit of price fluctuation in early 2015, so I did not include that to try to get a more stable base. But you can see Silicon Valley overall has got an 82% appreciation. Santa Clara's got 98%, San Mateo 67%, and Alameda County 62%. And I'll try to point this out again, is even though Santa Clara County has 98%, that ranges from a 64 up to a high of 96. And here again, you can see what I was talking about earlier. If your highest level of appreciation is 96, how can you get a 98% overall appreciation? It's simple. If we sell more homes in Los Altos, Palo Alto, Saratoga, Los Gatos, and even Cupertino and Sunnyvale than we normally do in those expensive areas, or if we sell fewer homes in the more affordable areas, downtown San Jose, Milpitas, Campbell areas, and even South County, or fewer homes in those areas, you're raising the price for the county, but not raising the price within each one of those micro market areas. That's one of the examples of where micro market data is so important. Is real estate's local, you can't transport it across from Campbell to Milpitas easily, and therefore the markets are really different, and these numbers show that. And then if you look at San Mateo County, I mean, it's mostly blue, so it's done the least well in appreciation. And again, I think that's related to better remote working than there was initially, before the pandemic, that is. So basically, San Mateo County, the desirability of being close to workplace is less valuable, and therefore they're having less appreciation since the pandemic than Santa Clara County. Here now are the prices, and again, I have the cheapest 10 percentile on the left-hand side, the median down the middle, and the most expensive 90 percentile on the right-hand side. So if we take Los Altos, for example, 80% of the homes are between 2.8 million and 6.7 million, with the median being 4.4 million. That just gives you a better idea, a better understanding of what's happening in each micro market area than just the middle median number. Here's the active listings compared to normal. So you can see that inventory is pretty normal. There's a surplus of inventory in San Mateo County because a surplus of inventory would favor the buyer. There's a lack of inventory through the central part of Santa Clara County, which would be things like Santa Clara, Willow Glen. This is offers accepted. This is probably one of the most pessimistic charts, but basically it's showing that we're selling less homes than we're supposed to be selling. We're only selling 78%. Santa Clara County is only selling 73%. We're missing more than 25% of the marketplace. And you have some areas like right now, like Milpitas, where they're missing a full third of the marketplace. Then you come down to San Mateo County, it's doing quite a bit better. But now if you come down to Foster City, it's only selling, it's 1/3 the homes. So but you know, Foster City, I got to make sure people understand that's a fairly small micro market areas. It's probably one of my smallest, not only geographically, but in the number of homes. It's very probable that the number of homes there is single digit. I don't know that, but the number of offers accepted in the last 35 days in Foster City and Redwood Shores is probably single digits. And then Alameda County, I do not have micro market data. Here again is a summary. We already talked about that at the beginning. That's a recap of what we've just gone over. We have been talking about the Silicon Valley real estate market. We will continue to talk about the real estate market. And then the last 8 minutes or so, we'll finish up with the Greater Bay Area, 5 regions, 13 counties. The handout is up. You can get that by typing in the green root URL plus the letter H for handout 2025. Today's date, 11/29. So it would be H 2025, 11/29. Here is the direct drive link. I did not have time to update it, so this is from 11/22, not 11/29. To attend the Zoom meetings and to participate and ask questions, you type in the green root URL in 2025 or the longer Zoom link. The archive, you type in the YouTube channel, or you type in the green root URL and you go there, same place. I'm Richard Calhoun, real estate broker, Creekside Realty. Contact information is there. Do represent buyers and sellers here in Silicon Valley in single agency transactions. Appreciate likes and subscriptions. Oh, that's a quick summary of some of the customized work I do when I'm working with a buyer, give you commute times and map links and school ratings to more value the data. And that way you can sort your priorities. And let's continue with the presentation. Here's more description of what's coming up. And this is the distributions. On the distributions, what we're doing is we're going back over the last 52 weeks. We're starting off on the dotted line, which is a year ago, very similar to the purple line, which is the current data. So see how similar those are? So the time to sell right now in Silicon Valley is exactly normal. That's what the chart's telling you. Let's step through. Now you can see that you've slowed down. So that you'd expect the market to slow down. You'd expect it to fall last year. That was the peak that we just saw. Then we'll rapidly increase. Notice how steep this gets over here. It's shallowing out, so it's already improving. That was the bottom of the marketplace. And now you're slowing down a little bit. So we're really not far off. You know, you're sort of in the middle of the marketplace, because there isn't much difference between it and the data right there in the purple line. And you have the extremes at the end of the year where you get very slow and then very hot at the beginning of the year. Look at that improvement. Look at that improvement. So we slowed down around July and then we improved again, and now we're slowing down. But we've been basically in the meat in the center. And so there's where we are. Basically, I'd expect the market for the next, it was about 3 weeks or 4 weeks to be slowing down basically through the end of the year. Then I'd expect it to rapidly increase. And the reason you get the steeper part over here is you have some overpriced turkeys that have been on the marketplace. And then as the market heats up, those overpriced turkeys get attractive and do sell. And then once the market starts leveling off, the top end comes down really fast, and then you start slowing down. This is the seller's price reductions. Now here, if you compare to last year, the dotted line up here, you can see the purple line, the current line, is actually quite a bit cooler. Sellers are doing more price reductions to have the same amount of marketing time. And again, we're starting on the dotted line, so watch where the market goes from the dotted line, and you'd expect the market to do the same from the current purple line. So there you're already slowing down. Now you're accelerating. So we've already had years that were slower, weeks that were slower this year. That's the peak, and it stays there for a little while, and then it starts improving. Now it's decreasing rapidly, which is a degradation of the marketplace, more price reductions. And now there really isn't much change. You know, it's getting worse, but then we also have that little bit better section right there. And I think we're going to have another one coming up right there. So the market, it does move up and down week to week, and you can see there is fluctuation. And do keep in mind that even though I use a 35-day moving average, I only get rid of 7 days at a time. So 80% of the data remains the same for the week to week, and yet you can see how much movement there is on that graph. And again, the dotted line is where we were a year ago. The purple line's where we are now. So we are significantly cooler, taking more price reductions this year than we were last year. And the third graph is the buyer's overbidding, and the concepts are the same. Again, you're starting off on the dotted line here. The purple line is the current, and you can see that we're quite a bit cooler, or we were quite a bit hotter last year than we are this year. So let's start off and look what happens. There's also a lag time on this data, so that's why it's not holding on longer and wasn't going cool right off the bat. But it does cool, then it warms up, it gets hot there right early in the year. Remember, again, there's the lag time, and that was March 15th. So 5 weeks earlier than March 15th, which is right around Valentine's Day, was sort of the peak of the marketplace. Now you're cooling off. There's the bottom. Now you're accelerating. So all three indicators cooled off right around the end of July. This was the middle of August, but again, there's the lag time. And so the market, all three indicators are reflective and saying the same thing, but you have to adjust for what the market is doing, because the market is determined when the offer is accepted. Overbidding isn't known until the offer closes. That's how that lag time comes available. Here's some details of those that are going through on their own. And the details do print up on the PDF that is available for those that want to download it. Here's marketing time. Here the concept is the purple line is the current data. The gray line's where you'd expect the market to be. And then the red line down here is the hottest, the most favorable to the seller. And the blue line is the coolest, most favorable to the buyer. So you have a whole range. It gives you a sense of where we are. Because real estate is so cyclical that, you know, a flat horizontal line doesn't really tell you anything. You know, the magnitude, the raw count doesn't tell you anything. But these curved lines, if you could imagine that's what you should be measuring things off of, that's what gives you an idea of what's really happening. The market is pretty close to normal, but it's between normal and a little bit on the side of favoring the buyer. Here's on a percentage basis. So you can see right now we're about a 15% lower turnover rate than normal this coming week. I'd expect more inventory coming on the market this week without time to sell it. So I'd actually expect this to go up, and then I would expect it to come down. So we're 14 days away from me coming back and saying this number's back down here anywhere close to 100%. Here's your typical marketing time. We're basically right up here at the blue line. So your marketing time is actually some of the longest that you would expect. And I think that's to do with the holiday change that I talked about. See this little V here? That's the impact of Thanksgiving, and when it's changed over 10 years. This year is the latest. So next week, I expect this to come down and then back up slower. Here's a percentage of normal. So we're only 8% longer for the typical seller. That's that 75 percentile seller, 3 out of 4 sellers, to eliminate the ones that are come on the market and sell right away. Now we're looking at the sellers that take the largest price reductions. What are they doing? And right now they're taking almost a 15% price reduction, which is pretty significant when you figure the median price home in the Silicon Valley area, at least in San Mateo and Santa Clara County, is around $2 million. Yes, it's lower in Alameda County, but still 15% of $2 million is $300,000 off their ask price to get the offer to come in the door. But that's what the sellers that are taking the largest price reductions are. Remember that only about 22% of the sellers are doing a price adjustment at all. So most of the sellers are coming out of the marketplace at a reasonable price. Here's the frequency. So price reductions are a little bit more frequent, but not even 20% more frequent than they normally are. You can see we were up here at 60% more frequently and have been basically improving. Here's an average. So this is for those that want a more common number. So the average price reduction is shy of 1.6%. It's a little over 1.5% price reduction. That's pretty insignificant. But again, it's not, you're not going to see a 1% price reduction out there. You're going to see sellers that are taking 10% price reductions, or a lot of sellers that are taking no price reduction whatsoever. Here's that price reduction compared to normal. So you can see that we were taking much larger price reductions earlier in 2025. We're coming back down. We're approaching 100%, but we're not in that narrow band of what I consider normal. To some degree, I probably should adjust my normal band, because if you look at this particular metric, the amount of time that you spend in this cool marketplace is a little bit higher than I would anticipate. So I probably need to decrease the amount of blue on here and not make it equal. Here's the frequency of price reduction. So this is where we get the number I've sort of been batting around, and it looks like it's close to 23%, which is the highest we've been in a long time if you come back here. And so you have to go all the way back to early 2023 to get a higher percentage of the sellers doing price reductions. And notice the peak, the highest we've ever had in the last 10 years that I'm showing data for is at 36%. So that's, a little over 1/3 of the sellers doing a price reduction. So it's not that common. And the vast majority of sellers do their homework and price their home accordingly. Here's the frequency compared to normal. So you're basically 20% higher price reductions than you normally do on for frequency. Overbidding. So now we're looking at what the buyers are doing, and we're basically right at normal, which is somewhere around 1 3/4% over the seller's ask price on average. The numbers that you were seeing earlier, the 5%, that was the average. This is the median. So this was the point at which it talks about half the sellers get more than 1 3/4. Well, call it 2%. More than half the sellers getting 2% over the ask price, and half the sellers are getting less than 2% over their ask price. Here's overbidding compared to normal. So the magnitude of overbidding is darn close to normal as far as the average. It's about 0.5% higher than normal. This is the frequency of overbidding. You can see we're right at 60%. I think Santa Clara County was at 59%, and the others were slightly above 60, if I remember correctly. But you're basically right at normal. You can see that you were taking quite a bit less overbidding through about August, beginning of August, middle of August, and then you started getting more. And remember, again, that's a price lag. So this improvement started right around the middle of July, end of July timeframe. Here's the frequency of the overbidding compared to normal. So you're basically somewhere around 96% of your normal amount of overbidding, pretty darn close to normal overbidding. Here's a pricing model and pricing. So this is on log paper. The advantage of log paper, you can draw straight lines, and that gives you the appreciation rate. We can have debate all day long on exactly where you want to do it. I try to keep it simple. But if you gave yourself a 12.1% appreciation, you'd be on the gray line. We were a little bit less than that right here through the 19, 20, and 21, but we caught up. But the more key takeaway is in recent years, the last 3 years, now soon to be 4 years, prices have been basically flat. Yes. And in fact, one of the biggest things I would notice is you have this trend of at the end of the year, prices are low, and they tend to be high during second quarter. But that's for 2 reasons. It's not only is that when prices are higher and property values are higher, it's also when more expensive homes tend to sell for whatever reason. So at the holidays, you tend to have smaller, less expensive homes sell. In the springtime, you tend to have more expensive, larger homes, or homes in more expensive areas sell. So you have a shift in the median for the county, or in this case, Silicon Valley, where it doesn't necessarily reflect property values. But overall, I would say we've had almost 4 years now of flat pricing. Here now is active inventory. So what we're doing here is we're looking at each one of the components for Silicon Valley and comparing it to the market range. And we're just finishing up on the last two. So inventory is basically right where you'd expect it to be. And it has been basically since midway through third quarter, or even just a month into third quarter. And the last one is the offers accepted. And you can see offers accepted did this big dive down because the holiday. I would expect that, because remember, again, the plateaus that you're seeing here is a 10-year average, 10-year median. And so less offers this past week. This week, I'd expect offers to come back up, but there's going to be no inventory, which is going to see a huge improvement. And then next weekend, we're going to see a flood of offers, and then normal inventory, normal market activity responding the week after next. Again, some text for those that are following on their own for the graphics that are coming up. Now what we're doing is we're comparing the 3 counties. So now you can see we've been focused on Silicon Valley only, so all 3 in a blender. Now we're seeing how Santa Clara in the blue, San Mateo County in the orange, and Alameda County are comparing to each other. And this is the turnover rate. Who's got the fastest marketplace? So clearly Santa Clara County is the fastest, about 33 days. San Mateo County is next at about 34.5 days. And the slowest is Alameda County at about 44 days. All very respectable. I mean, to say you would sell out your entire inventory in 44 days, that's pretty fast. Typical time to sell. Santa Clara County is again in the fastest at about 33 days. San Mateo County is about 34 days. And Alameda County is the slowest at about 39 days to sell out for the typical seller to sell. So this is related to turnover rate, but this only measures successful sellers. And it also gives you some idea of how long as a seller to expect to sell. You can price your home low and sell in the first weekend, or you can plan on spending about a month on the marketplace. And there are some sellers that are going to take longer, because again, there's 25% of the sellers that take longer. You have half the sellers that sell the first week. You have 25% of the sellers that sell between the first week and the 39th day, 35th day. And then you have 25% of the sellers that take longer than these time frames here. That's how the market breaks down. So you do have the full spectrum. Here's the average price reductions. You can see San Mateo County is actually doing the most price reductions at about 1.7%. Santa Clara County is doing the least at about 1.4%. And this again is average. Here's the frequency of price reductions, pretty close together. 22% for Alameda County and Santa Clara County. San Mateo County is doing the most at 24%. So none of our 3 counties right now is even at 1 in 4 sellers are doing a price adjustment. Overbidding. Alameda County has the most overbidding at 6.5%, almost 7% overbidding. Gives us about 6.75% overbidding. San Mateo County is next at about 5.25%. And Santa Clara County has the least amount of overbidding at about 3.75% overbid. And you can't sneeze at that. You go anywhere else in the country and you say sellers are getting 3% more than their asking price, and they'll look at you cross-eyed. Here's the frequency. These are very close together, all right around 60%. Santa Clara has the least amount of overbidding at 58%, and San Mateo County has the most at 62%, so a range of only 4%. Here's the long-term appreciation. Santa Clara County's at the highest appreciation. And this, again, is not necessarily property value in any given area or any property in Santa Clara County, because if you're selling more expensive homes than you typically do, then you're going to bring up the county's median without impacting the appreciation of any given property. And then you can see that Alameda and San Mateo County are much closer together, somewhere around 65% appreciation since the last 9 months of 2015. I have 14 on here because I go back to 14, but this is right here at this point. You can see how level prices were. That's my level point. That was the point that I took for my levelness. And again, you can start seeing the levelness, the fact that you've had no price increase for the last 4 years. Yes, you have this upside down N every year. And if someone wanted to say there was a huge price decrease in 2022 and we've been on a slow price increase since 2022, that's also a completely acceptable model. Here's the same information on regular paper for those that prefer. Here's your active inventory. Santa Clara County has less inventory relative to historical, because historical, the Alameda and Santa Clara would be roughly the same. So you can see Santa Clara County is probably the county that has the least amount of inventory. Here now is the raw counts of offers accepted. You can see that we're at 1679. That was the third worst year out of the last 10. You can see the 2022 and 2023 were lower. I think last week I mentioned this would probably fall below, and it has fallen below. So you're now the third up here instead of the fourth. And the numbers are close, but you can see that earlier this year, we were the second worst year out of the last 10, and more significantly, the second worst year out of the last 25. Now you're basically the third and fourth worst year out of the last 25, which is not as bad, but we're pretty close. So our volume has fallen down after the pandemic now, and we're way below the levels we were before the pandemic. Here's the raw count for those that are wanting to look at the raw numbers. You have Silicon Valley, Santa Clara County, San Mateo, and Alameda counties. You have the actual metric and then a sub-metric. So you can, and I have two levels of appreciation. I have 2015 here, which is what I've been plotting up to now. But those that want to look at the appreciations just since the pandemic, you have Santa Clara County having a 39% appreciation rate since the pandemic. And you compare that to San Mateo County at 18. So Santa Clara County has doubled the performance of San Mateo County since the pandemic shelter in place. Now we're covering the Greater Bay Area, 13 counties and 5 regions. The first region is Silicon Valley, which we've already talked about at length. Next is the cities, which made up San Francisco and Marin. North Bay, which is Sonoma, Napa, Solano, and Contra Costa counties. Central Valley is San Joaquin and Sacramento counties. And Central Coast is Santa Cruz and Monterey. Here's the descriptions of the slides that are coming up. Here's the first one, which is market turnover time. This is how long does it take to sell your existing inventory. Rapidly increasing on the Central Coast. The other 4 regions are going down, all fairly reasonable. Silicon Valley is the fastest at about 39 days. And then you have cities pretty close at about 45 days. And then you have North Bay and the Central Valley very close together, around 73 days. And the slowest is the Central Coast, now at 100 days to sell their existing inventory. Time to sell. This is the typical seller. This is the 3/4 sellers. Silicon Valley is the fastest, about 36 days. Then the cities is second at 52. Then you come up to the Central Valley at 64. And then you have the Central Coast, which is actually faster than the North Bay. The Central Coast is at 76 and the North Bay is at 78. So all still reasonably fast, Silicon Valley being the fastest. Price reductions. This is the average. So these numbers are fairly small. Central Coast is taking a 3.5% price reduction. Then you have the North Bay taking a 2.8% price reduction. Then you have Central Valley and cities very close together at 2.2% price reduction. And the least price reduction is Silicon Valley at about 1.6% of a price reduction. The sellers are reducing their ask price in order to get the offer in the door. Frequency of price reductions, how common are they? Silicon Valley is the least common at 21%. Cities is next at 28%. And then you have essentially a 3-way tie going from the Central Coast, which is actually in 3rd position, which is interesting given their turnover rate, about 39 days, Central Valley about 41 days, and North Bay about 42 days. All of them are increasing except for the Central Coast. Central Coast is going in opposite directions on at least two metrics at this point. Overbid, and this is the average overbid, so these numbers are bigger. Here we flip, and in first place is the cities at about 9.5% over the seller's ask price. Silicon Valley is at second at just about 5.25% over the seller's ask price. The remaining 3 are all below the seller's ask price, with North Bay and Central Valley, I'll call them tied, although they're not quite, at about 0.5% price reduction when the offer comes in, and the Central Coast is doing the most price reduction at offer time, and they're taking a 2% price. So that means the buyers on average are coming in at 98% of the seller's ask price. Frequency of overbidding. Central Coast has the least amount of overbidding at less than 1 in 5 at 20%. Central Valley is next at about 30%, so 3 out of 10. North Bay is just over 1/3 at 34%. Silicon Valley is just a tad under 60%, but I'll call it 60. And cities is about 60, about 2/3, about 67.33%. Long-term appreciation of the cities is doing by far the least well at 40%. Then you have North Bay at about 65%. And then you have Central Valley and North Bay is about 65%. And then you have Silicon Valley at about 82%. And finally, you have the highest appreciation in the Central Valley at about 86%. Here we have the median sold price for the different regions. The cities is the most expensive, followed closely by Silicon Valley, both right on each sides of $1.6 million. Then you drop down to the Central Coast at just over $1 million, North Bay at about 800,000, and the most affordable Central Valley at about 500 and a third, so about 535. Here's the estimated payments in the same order because I'm assuming an 80% 30-year fixed mortgage at the high balance conforming loan limit, including an estimate for property tax and insurance. Here's the number of offers accepted. They're going down in all regions like you would expect. I would expect another downturn this week just because there's no inventory. And then I would expect a significant up in 2 weeks. Here's the active inventory. So active inventory, I expect this to be actually up next week, but no time for people to write up offers. Currently, all regions are going down. And when I said up, the trend is down, but with the holiday, I expect the down to be more significant this week than next. So I do expect them to be higher for next week. So I expect to have a little bump, like sort of like right here, where you went down for the holiday and then came back up after the holiday. And here's a table showing you the different information. You have all 13 counties. You have the 5 regions. I also add in the Bay Area, which I think is a complete garbage number, as I believe most county numbers are even misleading and not giving you accurate information. And you have the current column is the now, then it's the percent change from 1 and 5 weeks ago. And with that, we're ready for any questions that anybody might have. I'm Richard Kelly, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley. Not seeing any unmuted mics. Have a great day. Take care. Bye for now.